Hello, it's Robert Miner with Dynamic Traders Group with our DT Trade Strategies short video for the week of March 27th. Here's where we do just a short video where we highlight one or two markets that might have some upcoming trade opportunities for the coming week that we do for our Twitter and YouTube followers, and it's a very, very shortened version of what we do for our DT Report subscribers. So if you like what you hear and learn today, check out the DT Reports where we have a 1-month trial available for first-time subscribers only at $19, from $19. And also, if you want to learn a little bit more, check out my book, High Probability Trading Strategies, where we go into trade strategies and trade management from entry to exit. Before we get started here, everything that I teach and I show you here is real-world trade strategies, practical application of the dynamic trading approach that we do. This is a Forex trading contest I'm in this year, and you can see I'm as of just the first 3 months I'm up 174% for this contest account, and this is real money, real trading. You know, it's not a pretend or paper trading account. And there's Carlo from Italy. He's just gone crazy this year. He's already up 900%. Good for Carlo. But everything that I'm going to teach you today, everything I teach in these videos, is applicable to any market, any time frame, for any actively traded market, regardless of whether you're trading stocks or futures or ETFs or indexes or Forex. It's all the same. It's all just bars on a chart. So let's get started and take a look this week at crude oil. Well, this is crude oil. It's the weekly data of the June contract. Weekly data June contract coming up from the April low. So 2 weeks ago, actually 3 weeks ago, we made what is probably a wave 5 high in Elliott wave terms, which completed a higher time frame, wave 3 RC. More than likely it's 3, it's not a C. But regardless, is we've begun what we call a weekly bear trend. We finally made 2 weeks ago on the weekly DT oscillator, we made a dual look back bear reversal from the overbought zone, and that coincided with a top that we made the prior week at the 100% alternate time projection of the last advance. The last advance 18 weeks, and 3 weeks ago was 18 weeks up, and we were just short of what would typically be the maximum for a wave 5, and that is the 100% alternate price projection of the net range of waves 1 through 3 from the wave 4 low. That was at 68.56. So our top was at 67.29, pretty close to it. And again, this is an important relationship because it's typically the maximum target if we've got waves 1 through 4 complete. So we were at 100% alternate time projection, 100% alternate price projection of the waves 1 through 3. A lot of other stuff was happening around then, but we were at time and price, and we finally had that dual time frame momentum reversal after it had been overbought for many weeks, but we had never had the bear reversal. We finally got that. So weekly high complete. So what's coming up here in the weeks ahead? We're going to get right down to intraday data, not just daily, but even intraday. So I can show you where we're at now. There's a reason I'm showing you crude this week today. So what's coming up is more than likely the market crude oil will be sideways to down into the latter part of May. So that's what, almost 2 months sideways to down. More than likely, at least. So what we use these time factors for is to give us an idea of the probable length of the trend in time. And there's other factors that we can look at that give us minimum and maximum, but these are two key time factors. It's the 62% time retracement of the last section up, and it's the 100% alternate time projection of the wave 2 or B. So if crude happens to be sideways to down in the latter part of May, we want to look at all the other factors to see if it's in a position to complete a corrective decline. So if we're making a corrective decline, because we had 3 sections up, a probable A, B, and C, is that we would anticipate that correction to be around 38 to 50% of what I got labeled the wave B. So that would be a typical target. Right in the midst of that is the 100% alternate price projection of the wave 2 or B. So we've got kind of a broad zone of around 55.44 down to 51.78 would be a typical corrective decline. So that's still quite a ways below where we closed at the end of last week, and we'll probably be sideways to down and reach in. Well, the average there is about 53.54, somewhere around there. Now that's not a forecast. That's just if a market reaches that zone, we want to be alert to the pattern of the decline and some other factors if it reaches into that zone, which it has a high probability of doing that. It's also that zone, the extreme of that, which is around the 50% retracement, is right around what we got labeled as wave 4 low, and that's a typical target based on a correction in Elliott wave guidelines anyway, following a 5-wave trend. So probably sideways to down for several weeks, 6 to 8 weeks anyway. Probably going to reach below 55, more than likely, as far as around 51. So quite a bit of time net bearish, more than likely. So let's take a look at daily and intraday. Here's our daily data just from the March 8th high. Just wanted to bring to your attention that the fast line of our DTI has reached overbought. That usually means we're within 2 or 3 days at the most of completing a daily high, which in this case, because the higher time frame trend is bearish, should be a corrective high followed by a resumption of the bear trend. Well, that means this coming week, near the first to the middle of the week, we'll probably complete a correction followed by a continuation of the bear trend. So again, it's not a forecast. We just know we're coming in to this is called a momentum cycle, which is likely to turn down early to the middle of this coming week. Here's just one simple time factor, high to high to high. That's on Monday. So we know early in the week anyway, there's some time, there's some price, there's some daily momentum. So I want to give you a little Elliott wave lesson this week. This is 240-minute data, and this is again the data coming down from the March 7th high, where the high on this 24-hour market was made around midnight, middle of the night. That's why it shows March 7th. So coming down off of this high, there's two equally likely wave counts. The reason I want to show you both of these, give you a little Elliott wave lesson, is because the outcome of both of them is the same, a continued decline early next week. So if you're into Elliott wave, and even if you're not, you might want to listen to this because it might be helpful when you look at another market in another time frame. Coming down from the March 7th high, 1, 2, and then 1, 2, 3, 4, 5 for the 3. And then if that's the case, we're making an wave 4 correction, and we're in that area of a typical wave 4 correction. And between Friday and Monday are some key time factors to complete a wave 4. Looks like it could be an ABC flat if we've reached near the extreme of the wave 4. So again, the intraday data is also indicating that early next week, more than likely, first day or two of next week, more than likely, we're going to complete a correction and a resumption of the bear trend. So that's a great trade setup that you might consider, and also be aware that it's maybe not a time you want to be buying, getting long crude. It's a time you might want to be expecting a continuation of the decline. But so in red here, I have another wave count, and that would be a 1, 2, and then 3, 4, 5. We've completed 5 waves decline. But again, if we have, we're making a correction. And when it's complete, what happens when a correction is over? A resumption of the trend prior to the correction to a new extreme. That means if this wave count is valid, we should complete a correction. It'd just be a higher time frame correction within the next trading day or two, followed by a resumption of the bear trend to a new extreme. So however we look at this, more than likely early next week, will complete a correction followed by the resumption of the bear trend. So great trade setup with minimal capital exposure and high probability outcome. That's what we look to identify. So it's not a forecast. Something completely different may happen. Oil may shoot through the moon. But what we know, and we always trade on what we know, is that crude oil is in a position within the next trading day or two to complete a correction. So if crude in Monday remains essentially sideways to maybe up a bit, and we get a reversal of some sort in price and momentum, whatever you use to identify reversals in the market might be a great setup for a short trade for a continuation to new lows, several more dollars on the downside in the weeks ahead. Well, that's it for today. I hope you have a fantastic weekend. Keep on top. Check out crude here over the next few days. Take what you learn here, apply it to other markets and other time frames. I'll be back with you next week. Robert Miner, over and out.